Hey Scott, welcome to the Raise today. So today we've got the pleasure of speaking with Scott Dommett. He's an investor at Rampersand VC based in Australia, and Rampersand seeks out founders with abnormal potential and a hardcore focus on big visions, big ambitions, and big beliefs. Their portfolio includes companies like Hatch, aka the Seek for Gen Z, Jigspace, aka the Canva for 3D, and MX51 Merchant Technology, where they invested alongside MasterCard and Artisan Capital as well. So welcome, Scott. I'm really excited to find out what's behind Rampersand's conviction for investing in early stage startups, and I know that our audience will be too.
Awesome. Thanks for having me on, Ryan.
All good. And Scott, as I was mentioning before, when we last caught up several weeks ago, you're actually over in New York. You were there on a bit of a mission. Do you want to just start off by telling us a little bit around what that mission was and how it went?
Yeah, definitely. So I was over there as part of a Victorian government initiative, which was sending about 3 junior VCs. It's supposedly globally. Everyone picked the US as the place to go. It's kind of the mecca of tech, obviously. And so we wanted the idea was to spend time in the ecosystem. You had a host fund that looked after you, did an internship with them. And alongside that internship, you are building networks in the US, meeting founders. I biased myself towards Aussie and Kiwi founders, because it was really interesting to hear how they'd successfully broken into the market. And there's a bit of a self-selection for success. The people that realize that they're going to succeed, people that are in the US have kind of thought, I'm going to break this market, and so go over there and throw themselves at it. So really weapon founders that I was meeting. I spent a month in New York and then a month in San Fran. New York isn't where like the center of tech is, but it's a lot more consumer. Some of the VCs were actually investing in restaurants and record companies, which didn't seem like usual VC investments, but were still really cool. And some great investors over there as well that tend to look over to Europe given the time zones. And then in SF for the last month, that was just hacker heaven. People were living with their co-founders, living with their employees, working 24/7. There's absolutely no nightlife in the city that I was able to find because everyone was too busy building. I think one of the really interesting insights is like the US is looking at Australia, but doesn't have boots on the ground and visibility exactly into our landscape. So all they really see are the people that move over. But particularly some of the funds are like specifically only able to invest in the US. What that means is like because as I said, the people that move over have usually built up a bit of traction in Australia and then headed over. They tend to see fantastic founders that have moved over there, and they're biased towards believing that Aussies and Kiwis are like really incredible operators. One thing that they love about us is capital efficiency. And I'm sure we can get into it later, but the US has capital abundance in the venture ecosystem, and lots of tech companies being built. Australia, New Zealand is a slightly more nascent ecosystem, a little more conservative in the way it deploys, and a little less cash to actually deploy, so smaller round sizes. This, alongside the like cultural differences between us and the US, this actually means you get these incredible founders that are able to do so much with, I don't want to say so little, but certainly a lot less than what the US people are able to do. And the Americans love it because it's in the US, if you give someone $10 million, okay, they get a really cool looking office overlooking the water, and they hire 5 software engineers for $1 million a year. And versus in ANZ, it's like, here's $1 million. Oh my God, you've converted into $1 million revenue. You've got a small elite team. So yeah, definitely one of the big lessons I took away was the way that our ecosystem builds great talent, like grit, particularly in the face of a little bit less capital, is really appealing to US investors, and they really want to find great founders they can invest in.
Nice. That sounds so interesting. I've got a bunch of other follow-up questions. I'm already feeling like this might become a big part of the interview, which will be cool because it sounds like you had such a great time. With that in mind, you talked about how much the US investors really value Australian and New Zealand startup founders because of some of the reasons that you've talked about. What's the best way to go and seek them out? Because obviously they don't have the boots on the ground in our region of the world, as you mentioned.
Yes, this was the perennial question of the trip. One that I interrogated like both founders, investors, a quite a lot of people trying to find a secret of the universe that I could bring back and be like, guys, if you go to this cafe, it's you raise your $10 million Series A easily. It wasn't as simple as that, but there were some like tried and true paths to get over that. The context I should provide behind it was what I discovered is US venture capitalists, and this is broadly speaking, so everyone was slightly different. Generally, even if you've scaled well in Australia and New Zealand, if you don't have proven ability to go to market in the US, and that's either through revenue traction or user traction, they'll tend to discount your ANZ revenue to zero. So if you feel like you should be raising a seed round, over there they'll be like, yeah, but it's too risky for us because we don't know whether you're going to be able to break into the US. And so you either can't raise the round or they'll just push you around earlier. That all changes once your revenue is starting to look like 50% US, or you have a few more customers over there. They'll actually start to think they will no longer have to discount your ANZ revenue because they'll know that revenue is also proof that there are customers in the Asia Pacific region. And so you can kind of it starts to accelerate once you have those first US customers. They start to pay attention to you, like can think of you as real. Again, generalizing, like there have been some great Aussie founders and New Zealand founders that have raised while being over here. Yeah, so that's just like the background context. When you want to approach these investors, you have to, know that. The number one thing that they're going to want to know is how does your traction over here translate into success in the US, which is like presuming that that's your final market. And if it isn't your final market, like I'd push you to go and find investors in the market you're scaling to. The two parts that I found were the most successful were, one, a early investor in your company, like a Aussie or New Zealand VC, has a network over there. They invest in your pre-seed, seed round, maybe your Series A, kind of at the latest. You then use that capital to move over to the US. Now, when I say move, you don't just move your operations. Like the best thing to do is to move over there. Like all the Aussies and New Zealanders that have moved over there have said that the best decision they made was actually being boots on the ground. Otherwise, they were just doing lots of frequent flights over. So you take that seed stage capital from over here, you prove out that you can go to market in the US, and then your next round is led by a US VC, or you can actually bring in US VCs because they no longer need to, you're there, you've got traction, they no longer need to discount. That's kind of like a completely biased view as well. Like that's the perfect investment for Rampersand, but it works. That's why it's our perfect investment for a reason. The reason it's really good is like Australian VCs can be a massively positive signal for you. So it's like, I vouch for these guys, they're good, or guys and girls. The other method that does work is the ANZ community over there is, there's lots of us that have moved over and all of them want everyone to succeed. That was kind of like this spirit, similar to the Anzacs, this spirit of mateship. Literally any founder you meet that's in a similar space to you, ask them who their investors were, get the referral in. Everyone succeeds from everyone else's success in a nascent ecosystem. It was just definitely the feeling that was over there. Everyone was very keen. Whenever I met B2B investors, consumer investors, I'd just connect them together. They'd always just share their network. It was fantastic. The reason you have to do that a little bit, apologies, right, if these answers were all like 10 minutes long and they'll ask you 2 questions. The reason you have to do it a little bit is because in the US, it's so network driven with like Harvard and Stanford graduates helping each other out. And like usually the investors are also Stanford, Harvard people. So what you need to think is like, who is my support network that's the equivalent of that? And in my opinion, it's the ANZ founders and investors, but like your investors kind of have to be on your cap table for them to do this. That will be able to help you and want you to win over that. So the 2 parts of that, warm intro is super important, is kind of what I should open this with. But the other, like the third and like, it's going to be a grind path is just outbounding and trying to meet people through cold emails. But the VCs get so much inbound over there that's like almost not worth doing. Yeah.
Yeah. Interesting. Yeah, and that does make sense. There's probably so much inbound going on in that market size as well. Those warm intros make a massive difference in both our part of the world and over there, understandably as well. So that's so interesting. So it sounds like you basically have, if you have US revenue, your ANZ revenue counts, and if you don't, it doesn't really count.
Yes, exactly. Even at like high revenue numbers, if you're Australian, they'll just see you as an Australian or New Zealand company as opposed to like a global company. It's a massive unlock having even just a few customers over there.
And with Rampersand, do you look for companies that are like, just to reframe this actually, there's companies make a couple of decisions. Most SaaS companies that are B2B, which is the majority of who Atlas works with, and I know the majority of sort of tech ecosystem tends to be B2B in both New Zealand and Australia. It seems like some of them make a decision to try to go global from day one or test out their product in New Zealand and Australia first, just so they can get that initial traction and then go over. What is like Rampersand ideally looking for in an early stage startup? Because I know that you focus in that area in particular with your most recent fund.
Yeah. Such a hard question to have like a general answer to, because it's definitely case by case. Before I just give guys, like everyone just immediately jump over to this. Like if you're still iterating on product, one of the beautiful parts of being an ANZ is like you can build a lot closer with customers because there's a little less competition. Like you're not fighting with the US tech ecosystem over here, especially at the early stage. The US is certainly not going to come to Australia as their like first market exit. They're going to scale over there. So you can kind of use the fact that you're over here to get a bit of a leg up on product, to really lean into customer conversations. That's a bit of a superpower. The way that I was describing it to US VCs, because they were like, they're non-competitive with us. They're not going to invest in a seed stage company that has only Aussie revenue. But we will make that bet. And Australian and New Zealand VCs will make the bet because we've seen Australians leave here before. We've got boots on the ground. We know how incredible founders are here. We know that it's, even though, but different countries, there's like some cultural similarities that mean success here can translate over to the US. It was a bit harder. There's more competition, but because of the easiest example, I'm going to take the low hanging fruit is Canva. Come out of Australia and basically have built a behemoth company, and no one expected it to happen because, it's just like a couple of Australian founders. Like, how are they going to build $1 billion company, especially horizontal, like so difficult? And then they've gone and done it. The US is starting to realize that people can do it. Australian and New Zealand VCs know that we can do it. And therefore, we're willing to take the translation risk. I'm trying to come up with the right word, pre-risk. But translation risk is where I'm currently sitting between Australian and New Zealand go-to-market and US go-to-market. And US VCs aren't willing to take that bet on the most part. So we'll invest in a company that's thinking of expanding over there but hasn't yet, and support you in your journey. That's kind of how we think of it. Absolute bonus if you've already got customers over there, because you've already started to prove it out. There's a lot less leaps of faith for us. Means that the conversation goes a lot smoother, because you need to craft less of a narrative of like, okay, I know we have no customers right now, but like, believe me, we're going to get there. If you've got one, even, you're like, I'm proven I can sell over there. It makes the conversation a lot easier, but it's not a prerequisite.
Interesting. And I think when we think of doing business in the US, we think, it's very commercial compared to New Zealand and Australia, maybe more competitive, and perhaps a lot more sales driven. And we need to really come out of our shells to push our product hard and show what we would maybe feel like is like an outsized level of self-confidence and self-belief that maybe doesn't feel as comfortable. You've just been on the ground there. You've talked to US investors, startups, and also startups from our ecosystem as well. Can you talk to some of those stereotypes? How true are they? And how much of a challenge has that really been for some of the startup founders from ANZ that you met?
Yeah, they're true. They're definitely true. We are such, as a culture, we're all so friendly. Tall poppy syndrome is like very true. It's not like it's a stereotype that actually sticks And you notice it even when we're getting pitches from Australian founders, New Zealand founders, it'll be, a bit of a rounding down. I'm not sure if I'm going to be able to do this. This is the area I'm going to go to. In the US, I'd speak to founders and you'd get to the end of the conversation. You'd be like, I assume this company's worth $1 billion because the way that you've spoken about it, I assume that you've already cracked the market. And you look them up on LinkedIn, they've been working on an AI, CRM for a month. You're like, oh, okay. The way they sell themselves over there, I describe it as ANZ rounds down and the US rounds up. So when you look at someone's LinkedIn after a conversation with an Aussie founder, say, you look at it and you're like, oh, wait, that's way more impressive than I thought it would be. And then you go to the US, you look at their LinkedIn afterwards, you're like, what? Well, you're a CEO of Tesla. Like, what the hell? You're like a PM for 6 months there and you quit to the startup. That was definitely one of the big stereotype differences, and we have to push through it. The reason is because they're so used to getting pitched over there, these grandiose visions. If you don't pitch a grandiose vision, you kind of sound, weak's not the right word, but like that's the kind of vibe you get. So that's one. The other thing is the networking over there is a different beast. People, if you go to a networking event in ANZ, you like to have a 10-minute conversation, you have a bit of a laugh, you like get to know the person. And I think everyone likes getting to know people quickly over here. Over there, it was surface level. Within a minute, LinkedIn's out. It was unhinged. So the LinkedIn's flying out at me. I'm like, literally, you haven't said to me what your name is. I'm learning it because I'm seeing your LinkedIn. But it wasn't, it was insane. It wasn't like that was a bad thing because they would also go, oh my God, you have to meet this person. Like if you're building in the same space as me, you need to sell to this guy. This girl over here is like in the right space. And then they would actually make the connection. It was like instantaneous value adds. But in ANZ, people are a little more hesitant to share their network. It's like, oh, you're building in the same space as me. Like we might be competitive. And so maybe I'm not going to share my network. So look, I don't know what the lesson is there. I certainly think that we could be better at like encouraging each other, supporting each other over here. Although at the same time, there's less people. So maybe your network is a little bit more valuable here. Yeah, definitely one of the other massive cultural differences was that, pitching and networking were just so different.
Yeah, interesting. And you went to New York and then you went to San Fran. You described both of those as being super different. A couple of our clients actually are in New York right now, both Australian clients and New Zealand clients, and a couple of our clients, well, a few of our clients also in San Fran, both Australia and New Zealand as well. So we've kind of got a foot in each place as well, in some sense via Atlas Digital. But how would you describe how you would recommend like which location to go to first? It's a big decision in terms of where do you want to move. That's massive. Maybe means moving your family, definitely moving your life for a period of time. Do you start in New York? Do you go to San Fran? What's your view?
This is a great question. And like, again, I've only been there 2 months. I don't want to pretend like I've conquered the US and I'm about to release like my tell-all how Australians should move over. But I think it is a really important decision, shockingly. One thing is New York is insanely expensive, more expensive than SF now. In my opinion, that's certainly what my bank account was telling me. And so if you're going to HQ in New York, there needs to be a real reason behind it. Now, one of those reasons could be it's an incredible city and you just want to be building in such an awesome space where at 10 p.m. you can clock off and it's still a buzzing metropolis. Like that may be a reason. And that's probably, I wouldn't blame you for that. It's great. But outside of that, I would actually suggest if there isn't a specific reason to be in New York and like similar with SF, I would actually push you to just think of being in another city in the US. Like Austin is awesome. It sits in the middle of the US. You get the best of both time zones. So you can have US customers. You can fly to people if you want and you're not paying exorbitant fees. The average salaries is lower, which is good. Now saying that, if I could try and think of a reason to be in New York, it'd be consumer. Like so many people, you could actually find customers really easily. People have a higher propensity to spend because they're used to just like emptying their bank account every time they go for lunch. So it's like, what is a small subscription to them? So if you're building consumer and if you're building fintech, because obviously a lot of the banks are headquartered there, it makes sense to be in New York. And like maybe you're willing to pay that price to have that as your landing pad. But otherwise, yeah, seriously, think about it. SF is like, if you're going to sell B2B or you're going to sell to startups, okay, well then be like in SF, as you're coming from the airport, it'll be like Anthropic, OpenAI, billboards, like they're all selling to each other there. It's incestuous. But that's, if your customers are that, then it makes sense to go there. But again, if you're more of a horizontal play, or you just like selling to SMBs, like gyms or whatever, that's just like not specifically required to be in one or the other, then just think about being in a city that doesn't cost you an arm and a leg to be in. Is the other option I'd push for.
I guess that comes back also to your very capital efficient answer as well, that those US investors like as well, right? Move to a city where financially it makes sense. Scott, you raised a really interesting point around the New York time zone actually being a little bit more conducive to working with companies based in London or the UK, as well as maybe parts of Europe. It's also an easier flight as well. Do you think that plays a role in things? Some companies that we've come across will work in like Australia, they'll be in US, and then I have some clients in the UK as well. It creates like a really big footprint around the world. And I find it seems to be really hard to make all the time zones line up, especially when you're targeting the UK and you're like in Australia. It's literally like no one's having a good time on that time zone difference. Was that a thing or not really?
Yeah, definitely. It's always funny when there's an Australian, UK, and like New York or SF person on a call. The Australian time zone is the one that people are like, who cares? Like they'll figure it out. It possibly is. It so definitely was that the VCs that were in New York were looking at European, had partnerships with the European VCs, like Israeli VCs and companies coming out of Europe. Like it makes a lot more sense for that to be the landing pad of European companies. I think it's like, if you've got European customers already, which is like awesome, and US customers, then perhaps like that would factor into your decision. And like New York would make a lot of sense to be a place to be. SF like doesn't have great time zones with it. But yeah, I wouldn't say I've met a huge number of Aussie founders that have like already crossed all three oceans and had like European, American, and Aussie customers. So potentially.
Yeah. Nice. And then tell me a little bit about Rampersand. So currently you're mainly invested in early stage startups, been pretty active, I think raised a fund in 2021, if I've got that right. And one of the things that it sounds like you're really looking for are category creators. So, building companies that are doing their own thing as opposed to just, I suppose, like an iteration of what sort of company people had produced to solve existing problem already. Do you want to talk to us a little bit around the focus on category creators?
Definitely. And category creators is one of those terms similar to product-led growth, where it's got a vague enough definition that like it can sometimes feel a little airy-fairy. But similar to product-led growth, I think you've got a category creator when there's a certain feeling that crosses you. So in product-led growth, it's like, I don't need to touch anything in the company scaling. With a category creator, the feeling that we get as investors that we know we're on something is when someone tells you their pitch and it feels like they've told you a secret of the universe, which is a very poetic thing to say. But if someone tells you something and it's like, oh, that makes sense, it's generally because they're building in a category that already exists. A category creator has seen something, a way that the world should be that it currently isn't, that like fundamentally will disrupt the way that we're approaching, either B2C, B2B, like marketplace, anything. And that's what we love to invest in, the people that have seen that secret and are going to scale from there. One of our most recent investments, which I'm incredibly excited about, is Restoke. So they're building now, people have been running restaurants for a while. It's like, and software has existed to help you run a restaurant for a long time. Toast is a massive vertical SaaS product that restaurateurs are using. What Restoke is is the brainchild of someone that's been running a restaurant for a long time, a staff, and someone who's incredible at tech, Ken. And it's the melding of those two minds that have come up with something which, in my opinion, is a bit of a secret of the universe. It is there is all this information in the back office or the back house for a restaurant, and it's all over the place. And these, like, basically you're barely keeping on top of things. If the price of bacon goes up $1, you might accidentally be selling a burger at a loss, which seems insane, but like there's no way to keep on top of things. The first version of what Restoke is building is literally just like pulling all of that information together. Now that's in and of itself an incredibly powerful tool, but what made it, and they built an incredible process for doing it that's like super easy for restaurateurs to onboard, because usually like they prefer to avoid tech. I completely understand, especially when they promised so much and undelivered in the past. And that's cool by itself, is what I'm saying. Where it becomes a category creator is when you combine that understanding and knowledge of a restaurant with the cutting edge developments in AI that we're seeing at the moment. And if you could, what they're building is this system that brings both of these together in effect to build the restaurant brain. And this is the first version, it's Skynet for restaurants. This is the first version of like everyone runs a restaurant differently, but there are optimal ways to run a restaurant. And short of selling like consultants coming in to pay for things or, secrets whispered at various conventions, it's actually really hard to implement them in your own restaurant. And a category creator like Restoke is going, you literally can just have on tap a restaurant intelligence that's going to like change the way that all restaurants in the world are run. You no longer need the owner to be sitting there going like trawling through all the various numbers, to see if there's like one difference, like identified leakages. You just have something that exists, a living, breathing part of your restaurant that's telling you, oh God, avocados just went up $5. Like we should probably either change our menu or we should, increase our prices. And then they can do more than I keep coming back to prices because that's the basic thing. But you can be like, if similar restaurants to you sell in this bundle, and if you sell it at this rate, you can sell more. Or if you run a deal on a Tuesday, that's what actually gets people to come in. And it's just like a level of, it's a superpower that restaurateurs are suddenly going to be able to have that's like previously was impossible. And so that's the kind of category creating stuff that really that's what gets you really excited. But it's rare. It's really rare. And also sometimes you get like red herrings. It feels like it's a secret of the universe. Is like at the seed stage, it's hard to know whether it's actually going to break through. But yeah, at Rampersand is certainly what we're focusing on. And those are the big disruptors that they change the shape of how we operate in society.
Awesome. And I think Restoke's a great example. The hospitality sector, as you said, there's so much software there because I guess it's not a hugely tech-enabled industry. It has been around for a long time with sort of like clear, pre-existing, but ongoing and unsolved problems. I think one of the big things, because, we do a lot of targeting across basically all verticals for B2B SaaS. We've basically done it all. And I think that hospitality, generally speaking, tends to be a harder one to go to market for and to acquire customers for. There's a few reasons for that. Often, if you're targeting small cafes, then it's always owner-operator, and so they're a hard-to-reach audience on digital channels. They're also hard to identify. Most people don't call themselves a very certain title or describe themselves in a certain way online that makes them easy to find, as opposed to in-house corporate lawyers at 500 to 2,000 person organizations in the US, much clearer. But obviously, a lot of these tech products for hospo do add a lot of value. The point that I wanted to get to is that I think a lot of the issue where it can be hard to make them work is because hospitality is a really like margin constrained business already. They're already working on super slim margins, and often if you're offering websites to hospitality in a software delivered platform or like point of sale software and all of those types of things, they're all great. They help the restaurant sell more, but they cost the restaurant more money, and so it becomes harder and harder as they continue to put downward pressure on their margins. So yeah, I was really interested to hear about Restoke just now because it's the opposite. It helps them expand their margins and actually do really well. And I think speaking more broadly now, there has been a bit of a downward pressure on software in general. Obviously, there's recessions basically in all Western countries at the moment, it seems like, for various reasons, and hospo, construction, etc. Those cyclical industries tend to get hit a little bit harder. But I think that where we've seen our clients being really successful are those B2B SaaS products that offer something that saves, it pays for itself, it saves money, or it enables them to make more money, as opposed to in a profitable way, as opposed to just sort of streamlining what they're doing. So yeah, I'd love to hear more about Restoke as it happens. It sounds like an exciting product for sure.
Yeah, definitely. Then the other thing, exactly in this space, is specifically for restaurateurs, super time poor. So if you're offering them something that's going to take 10 hours to set up, and it's like a sole operated cafe, you just like, I literally don't have 10 hours to do this. But very interesting, you commented on people are willing to pay for tooling right now. It's has very obvious ROI. And it's I can't hire any more staff. I need to be more productive, reduce bottom line, let go of staff. And a massive wave of that is this phone receptionist, or AI call centers and AI customer support, seeing a massive amount of cost reduction being the motivator there. And yeah, on the revenue side, definitely Restoke has the power to do that. It's rarer to find specifically AI solutions at the moment that are able to generate a more powerful increased top line revenue, a lot of expense reduction, not a huge amount of revenue increase, really cool solutions that are doing that, but a bit rarer. So yeah, interesting that's the trend you're seeing as well.
Yeah, that does make a lot of sense. It's actually a great insight about, I hadn't thought about how AI is really empowering savings as opposed to expansion. That's really something to think about further. And category creation in general is also really interesting from the perspective of Atlas Digital. We help companies go to market, or we help SaaS scale ups, improve their acquisition systems essentially, particularly in markets like the US. And coming back to that go-to-market aspect, we help early-stage startups of all types do that in their different regions that they're going after. But I've noticed really big differences between category creation and what you need to do, and then also a B2B SaaS product that might sit in a pre-existing vertical with pre-existing competitors. Category creation is quite hard. Obviously, the biscuit's bigger. At the end of the day, there's more you can have the whole cake to yourself if you're that first mover, but there's a lot of discovery that needs to happen and education, and it's also hard because you have to push out and find all the users. It's on Google search, for example, someone's looking for scheduling software, probably 1 billion searches globally for scheduling software. I would say there's probably an exaggeration, but you get the point. And I think that in category creation, people just aren't searching for what you're looking for. So you need to completely know who your ICP is, and get super into that market research element to understand who you're actually going after. And then 2, you need to kind of have this year of patience of a good marketing plan where we're going, they need to know these things, we're going to create this many touch points with them, then just go out and do that without necessarily getting that instant feedback. Is that your experience? And feel free to disagree. How have you found what are the challenges for category creators going to market?
Yeah, definitely. So if I want to circle back to my favorite phrase, which is category creators knowing a secret of the universe, that secret of the universe has to really be an actual customer pain point, something that people are generally motivated to try and solve, but they don't currently have a solution to solve it. You can't sell something to people that they don't realize they need, and it comes back to as a category creator, you're trying to build a new behavior into people, and so you need to figure out what the trigger is for them to actually do it. One of the interesting, if I was to, I have a slight anecdote on this, which was at the start of last year, I was trying to build a product in the subscription space. Rocket Money in the US, super successful at this. Basically, everyone's just got subscription services, you forget they exist, and there are solutions being built to help you manage these as a consumer. We tried to build it in Australia because we didn't, at the time, there are a few now, see any actual solutions to it. But we were struggling to get traction. And so we did this survey to a lot of the people we'd spoken to. And the two pertinent questions were, have you forgotten a subscription in the last month? In the last 3 months? And do you feel like you're on top of all of your subscriptions? And like the second question being like, is the actual motivator, and the first one being the real problem in society. We found basically everyone had forgotten this subscription in the last 3 months, and basically everyone thought they were on top of their subscriptions. So it was like, the issue there is you're not going to have an actual motivator from customers because they don't believe they have a problem. Trying to absolute tangent. I'm not really sure where that one came from, but bringing it back to like this category creation piece, and I think of the universe is really believe that yes, you are going to be fighting an uphill battle to create new behavior, but if you actually figured out something that is fundamentally wrong, and there is a latent demand for that, a solution to that problem, then you've got your superpowered flywheel. The first few customers, you may have a vision of where you're going to build out to, and the first few people kind of get it, but that's like where you iterate with customers and build out to the true solution, or the thing that like the past Series A, you just pour $1 in and you get $4 out. Like, you don't need to do that at the seed stage as a category creator. You've got a vision for what you could be the solution. You're iterating, you're building, you're experimenting, and then that's where we come in and support you. And then past us, once you've figured it out, you've actually broken like, oh God, we've got something, we've broken this category, or we've created a new one even. Then Series A plus investors are the ones that are going to be like, awesome, you've got a proven go-to-market. Here's $1 million, turn it into $4 million.
Yeah. It's really interesting, and I like that. It sounds like Rampersand sort of gets in early stage and makes big bets on big opportunities, right? And I think that's sort of the superpower of a lot of the VCs in New Zealand and Australia as well, similar to being on like in a smaller region of the world and needing to perform really well on the global stage. It's like finding those opportunities to go and be to do something that can truly revolutionize a customer problem and solve it fully where nothing exists currently. With that in mind, I've been thinking quite a bit recently about the valuations and the growth of companies as well. Unicorn status is certainly something that people seem to be chasing a lot. What's your view on like how big a company should become? And I know that you're at a VC and there's the economics of making a VC fund work, but what's your take on that? Because I do feel that there's been this massive run-up, bull market, money's been available, and that meant that a lot of people understandably raised capital, but then that also came with an added level of pressure. And some of those have worked out really well, some are doing okay, and some obviously have failed. And I just wanted to get a sense from you, like from that perspective now that we're kind of at the bottom part of the cycle and we're going to look at probably another bull run in the coming few years, how big should companies be trying to be? Like, what should founders be aiming for? And also, should VCs be thinking about it differently?
Yeah, this is like an incredibly front of mind question, particularly because the pace of technological change as a result of AI and like it being a lot easier to iterate, it has increased massively. So it's a lot like when we're seeing a solution exist in the world, we're seeing very similar solutions hit feature parity, like spotted everywhere. Like there's a parallel realization that AI can solve a certain problem, and then people start building that solution everywhere. And it's not just happening in A and Z. When an idea is normally germinated here and there are a few other copies, what's unsurprising to realize is like, particularly in the US, definitely Europe, other people have figured this out, and it's like everyone's building it. So there's a lot of competition for these new companies. What that means is like a lot of people get to a fairly good size, and then it's always been hard to get to a massive company, but there's massive competition past Series A to get to like a Series B company. And that was like fairly common feedback I was hearing in the US. How big should a company get? Maybe taking a step back and going to like fund economics. Our most recent fund is about $50 million. If you're a $50 million fund and you're making a $1 to $2 million investment in a company and you expect like you're taking 10 to 15% ownership in that round, like perhaps there's more people, perhaps there's less people around, you kind of need the company, if you have a few more rounds of dilution, to exit at $500 million to $1 billion in order for you to return the fund once. And return the fund is an important calculation because generally VC funds are targeting, like a good VC fund over its 7 to 10 year life cycle is targeting a 3x return. So you need opportunities you invest in to have the capability to return your fund, and then you're expecting one of them to do really, really well and a couple of them just to return the fund. That's kind of how you end up at the 3x. And the traditional venture model is, as I've kind of touched on before, experimenting at the seed stage. A bit of capital comes in, we're exploring, we figure out the playbook. We've got the solution, we hit product market fit, and like Series A investing, typically, I mean, maybe it's more Series B now, is once product market fit exists, you're just literally pouring cash into the proven sales engine and scaling up. And that leads to lots of dilution because like you're literally like burning cash to get sales or build. An interesting new business model that's come up and it gets talked about quite a bit is this idea of like, when will the first $1 billion company exist where one person built it? And there's a massive amount of operational leverage that comes from new tooling, particularly like in sales orgs. AI can automate full divisions now. In software engineering, there's like a crisis at the grad level because AI is as good as a graduate software engineer. Like a lot of previously very hard tasks are now able to be done by like one person. So what that changes for VCs is if you don't need to raise a huge amount of capital following on, your exit can be a lot lower. So perhaps if you're going to raise at the seed stage, you know that you only really need to hire 1 or 2 salespeople and you can get up to $20 million revenue or $30 million revenue and perhaps exit at $200 million, but you never raise capital again. That can actually lead to return the fund outcomes, like maybe not exactly that math. I hope no one's fact checks this because they're very random numbers, but approximately, you can return the fund with that if you're not going to raise additional capital. And that may change things for VCs. Like maybe you just do a fairly big seed round and go, I'm done. Get a scale with this, try and exit for $100 million, which is still, all of these numbers seem insane. And they always have to me, even before I was in VC while I'm in it. But that's like the numbers you kind of need to get to. $100 million, you can exit for $100 million and everyone can actually be happy with that outcome. Versus in the old universe where you had to raise heaps of times, a $100 million exit may actually not be a good thing for your VCs. It may still be a good thing for you because they won't get the required like high risk, high return reward. So all of that to say, traditional VC, particularly if you're a seed stage fund like us, like the outcome we're targeting in a classic investment is 500 mil to a build. And maybe in the future, now that there doesn't need to be heaps of raises, you can, if you're literally thinking I don't need to raise again, that outcome gets a bit smaller. And again, this is like purely exits for VCs and like how we think about things. I can maybe say the salient point, which is like, if you're thinking about raising venture capital money, you have to be very conscious about how your VC sees what a good exit will be. If you're in the traditional venture, and if you're a seed stage investor like us, a $50 to $100 million fund, you're expecting them to raise up to Series E, F, classic path. You're expecting a startup to get to around a $500 million to $1 billion exit. That lets you return the fund once. Like that's what you need to be somewhat. You don't need to know that it's going to happen. I mean, if anyone knew that, that'd be the best VC investor in the world. You need to just believe that it's possible. That's kind of what the job is. And so that's the traditional path. And there's a new path that exists now, which is big early raises, utilizing all this awesome tooling that's come out, and you just only raise once, and you can get an exit that's more like $100 to $200 million. Your venture capital investor gets the exact same outcome, and it's kind of a smaller requirement for you to scale. It's still very difficult. And then, of course, you can just not raise venture money in any exit. You get all the outcomes. But you should only really be raising venture money when it makes sense for you. And that's like I'm incentivized to say that because if you raise venture money and it doesn't make sense for you, it's going to be terrible for everyone. And where it makes sense for you is you need capital to experiment, you need capital to scale. You have to have these various things, or you need like the strategic guidance, strategic network that we can bring to the table.
No, it's just a really interesting question, and I think it's good to reflect on both in light of the, as you were saying, sort of the leverage you get from AI. Really interested to see this, first $1 billion founder, solopreneur. Is a pretty exciting space to be in. It's been great to chat to you today, Scott. Just looking at wrapping up now. What's next for Rampersand? Are you still deploying funds at the moment? Like, where are you sort of at in the stage, and how do people get in touch with you?
So Rampersand has had a really interesting year. We've had 2 new partners, Karen, who was promoted from principal, and Andrew, who's come over from Europe. And that's like, we're setting ourselves up for success. Our vision of Australia and New Zealand over the next decade is that this is the golden decade of tech. We've had Canva break the way through, prove that we can do it. We've had a number of other successful unicorns, Linktree, Culture, Safety Culture, these like big companies that have succeeded on a global scale. And so now graduates can kind of see startups as a possible career path. People that were experts in various fields realize that they can actually do it, and there is an ecosystem there to support them. So Rampersand is very much viewing itself as riding this new wave of success and helping everyone along the side, not just riding it. I suppose it's terrible. The other thing that we've had recently is Rod Hamilton from Culture Amp's come on board. He was the head of product. He's incredible. He's been working with our founders to kind of bolster, like show them how to think internationally, how to build product fantastically. He's been a great addition. So it's been a really supercharged year for us. We've still got capital in our current fund, which we're deploying out of, which is a bit of a blessing in the current macro environment. And what we're super bullish on is we've traditionally done a lot of seed investing, but we're also really interested in this inception day zero. If you're a great founder, you've got an awesome idea, we want to be your first check. We want to be your partner to growth. And I guess reach out to me by email or LinkedIn. Those are the classic ones. And if you're that kind of founder, like, let's get in touch. Also, up to see. It really happy to speak to anyone. And let's change the world.
Thanks for your time, Scott. Love the energy. Love the conversations. We'll be putting this up online and sharing it around. Everyone get in touch with Rampersand or Scott directly if you are looking at raising a round or just exploring what your options might be there. And thanks again, Scott.
Thanks for having me. This was really fun.